It's been another tough day. It feels like this is mostly about recession worries. You've got the inversion of the 210 spread is even bigger, the worst ever. I could go on, but that seems to be the story today.
But really nowhere to hide today, Scott. Energy leading sector year to date, down 3%. You mentioned the inversion. We've basically washed away all of the positive technical momentum from Chairman Powell's speech last week. We've washed away all of the sentiment, the strong sentiment that potentially we were setting the foundation for a move higher. What did we hear? 43, 4,400? I don't think that possibility exists right now. So now it kind of falls back upon CPI on next Tuesday. Can CPI early in the morning lift markets? Can it reignite some of the positive momentum? But even with that, I don't know if there's enough there.
Yeah, oil, to your point, is now negative on the year. Who'd have thought, that we'd be having that conversation given where oil was?
I think what's troublesome about that is that oil is declining, but yet we're seeing inflation remain sticky. We're seeing an economic environment that as you look forward, we're losing optimism. And losing optimism about the economy is never good.
There is this developing story, too. I've mentioned several times this week, and it's a very big week for sell-side conferences. There's one for the financials going on today in which Goldman CEO David Solomon, just a short time ago, he's getting ready for a recession. He said he expects stocks in residential real estate to be lower a year from now, just 35% chance for a soft landing. Caution today, too, from Brian Moynihan, Bank of America, same conference. You heard CEOs from other sectors with much the same story.
All right, so potentially there's a message, and there's a direct message there for Chairman Powell and the Federal Reserve. The message ultimately is maybe allow the market to catch its breath. Allow the market, allow the economy to absorb, digest the historic rate hikes that we've experienced over the last 6 months. 375 basis points on the precipice of being 4.25. Let's keep one thing in mind, though, within that message. Chairman Powell can respond to that. He could slow down the rate hikes, but what he can't do is pare back the tightening of the balance sheet. And I think that I heard a lot about that today. I've heard that recently in conversations. Taking liquidity out of the market on a continual basis, even if the Federal Reserve pauses on the rate hikes, that means you're going to have persistent and elevated volatility. That means you're going to have a market that doesn't have the nourishment, Scott, of the last 10 years.
Yeah, I've mentioned all of this, especially from Solomon, taking place within the last 30 minutes or so, which is why we wanted Steve Leisman to join this conversation. So pertinent it is, Steve, as we approach another Fed meeting, and here we are with CEOs, gaming it out and thinking the chances are better than not that we are going to have a recession against the backdrop of the Fed tightening into that.
Yeah, it's not a good mix, Scott. And a lot of these CEOs, they have to do what they have to do in order to prepare for economic outcomes that they see coming. At the same time, Scott, as you know, that very preparation creates the situation that they're preparing for. So the idea of paring back employment, paring back capital spending, all of these end up being negatives for the future. And you obviously can't ask a guy to say, we're just going to hold the course because of the negative effects. That's not what happens. That's, by the way, what the government and what the Fed are for, to replace that animal spirits or otherwise that negative impulse from companies. But they're, interestingly, Scott, this time they won't be around. I'm not ready yet, Scott. As you know, we did a story the other day on the possibility of a soft landing, and some folks seeing that happening. The data has been pretty good so far, but you can't argue with what's in the book of these CEOs. If they're seeing the orders fall, then they have to be reacting. I will point out, though, that the data in general has led to upgrades to the economy in the last couple of weeks, not downgrades.